Hello, everyone. Welcome to our November investment webinar of Endorphin Wealth. Thank you so much for joining us today for the session. We are basically going to cover off some updates about, I guess, economics and stock selection and all those sorts of things that matter to clients. And one of the things that Endorphin prides itself on is making sure that we keep clients up to date and across I guess, information that we have available to us. And to do that, we pull on a wide range of experts to help us to deliver on portfolio outcomes for our clients. So we're lucky enough to be joined by two wonderful experts today in the room. So just heading through, actually, looking at, we're coming at you today from our Sydney office. We actually had the IFA Awards night last night, which the firm was up for 6 different categories where we were finalists. And one of our advisors, Robert Rich, won Client Servicing of the Year, which is very exciting for us. So we're all dusted off and in the office today, and of course, ready to get stuck into this update for you today. Without further ado, wanting to introduce both Isaac Poole and Chris Adams. If I could get you guys to come on screen now, that'd be great. And yeah, basically these two gentlemen, when I was, I know them both, but obviously reading through some of their bios, extremely impressive people. So we're very privileged to have them in the room and to be able to address us today on some of these really important issues. And if you think about, we ran the last webinar about 5 months ago now, lots has changed. We already had a bit of a backdrop. It was actually in June of what was sort of happening and where markets were moving. But I guess now we've even had more of that story play out. So of course, we'll be able to kind of talk through some of that today. So Isaac Poole comes so basically works with Oriana. So they're a portfolio advisory service that we engage to assist us with positioning portfolios and markets. Isaac has actually had some time with Willis Towers Watson previously, and also the New South Wales Treasury, and holds a PhD in economics. Chris Adams is from Pendle, so has been working with Pendle for about 8 years, and previously worked with HSBC and BlackRock, who are enormous investment management businesses that he's worked for previously, and comes with, I guess, working in the portfolio specialist position at Pendle. So Isaac's going to talk us through from an economic point of view, markets and outlooks, and Chris is going to talk us through a little bit more from the stock specific level. So running an Australian I guess, investment fund that we use as part of our managed discretionary account services. And so we can get a bit of an idea of the sorts of stocks and the portfolio positioning at current down there at Pendle. So Isaac, I'll get you to kick things off for us.
Great. Thanks, Philip, for the introduction. And thank you everyone for joining. I'm just going to move across to my screen share, which I hope works. And everyone can see my screen now. Yeah, thank you very much. As Philip said, I'm going to give a bit of a talk about the macroeconomic environment that we find ourselves in, some of the challenges that we've had this year, how they might resolve themselves, and what that loads up for next year. And then hopefully that'll be a useful point for me to pass over to Chris, who can take it away from there. So I've put the title of this, This Too Shall Pass, because it has been a difficult year. And I think, calling it difficult understates it a little bit. And I'm not a big one for throwing up a slide full of numbers in front of everybody, because it can be a little bit intense. So don't focus necessarily on the numbers here. I think what I'd rather bring your attention to is the red. And it has been a year full of red across almost every asset class that we invest in and that we typically would invest in within our portfolios. Here you can see 1 month, 3 months, 1 year, 3-year returns across broad fixed interest in Australia and international, and Australian and international equities. And what it really shows is, up until the end of October, up until the end of last month, it had been a truly bad year for every asset class. 1 year negative returns in fixed interest, 7% lower in Australia, 12, almost 13% lower internationally. These are almost unheard of numbers. It's very rare for fixed interest to decline like this over a year. Even more incredible is that the magnitude of the drops this year have left those asset classes negative over a 3-year period. If we go back to that 1 year column where we have negatives all along there, what is also remarkable is that assets that have historically been thought of as defensive, fixed interest, government bonds, investment grade credit, have not been defensive this year exactly when they really needed to be. In a year when international equities in US dollar terms have declined 18%, and in fact were down more than 25% at their trough, when Australian equities are down 2% and were down even more than that at their trough, government bonds have not played their role. And that means that a diversified portfolio this year has struggled a lot. Now, I went back through the numbers to try and see when we've had a year this bad across all asset classes in recent history. And the answer is we have not had a year this bad in recent history across all asset classes. You need to go back until the Great Depression in 1929 to find a year that was worse than this, where we are looking at a 1 in 100 year type event for a diversified portfolio. And what that's saying is markets have priced in a Great Depression-like scenario, despite the fact that we haven't had a recession this year. In fact, we've seen today that the Australian unemployment rate fell even further. The US unemployment rate is near historic lows. Economic growth remains okay, albeit slowing. So really, when you look at it from that perspective, it's worth asking the question, why on earth have we had such a challenging year in markets? And for me, there's a couple of important parts that are driving that. And so I thought I'd spend a little bit of time setting the scene, explaining why that sea of red across the asset classes. And to do that, I'm going to focus on two things, and two things only in this slide: inflation and interest rates. That's where the big story has been this year. That's where markets have been fixated on. That's where the challenges have been, and that's where the volatility is coming through. And it's coming through because we've had a very difficult set of circumstances for central banks to navigate through. That's caused difficulties for markets to interpret. So let's have a look here. You can see what I've got is inflation up in this top row, interest rates in the bottom row, the Reserve Bank of Australia, and the US Federal Reserve. Let's flash back to the start of the year. I think most people will remember, although it feels like almost a lifetime ago, that the Reserve Bank's cash rate was just 0.1%. And that was even though inflation was 5.1% in Q1. And in fact, the RBA was saying, we are not hiking rates until 2024 at least. They had a very clear message at this point in January. The Fed had a Fed funds rate similarly low at 0.25%, even though inflation was 7.5%. And you may recall that the Fed at the time was saying this inflation is transitory. We expect it will dissipate quickly. We don't intend to hike rates in a hurry. And we think that we'll have inflation very quickly move back to our target of around 2%. So that was the starting point for the year. That was what markets had facing them as they entered 2022 off the back of 2021. And what happened? Well, if we come through to our latest readings, we can see that inflation, in fact, in Australia is higher. And as a result, the Reserve Bank has hiked rates aggressively. They've hiked now from 0.1% to 2.85% in a very quick period of time. They're likely to hike again in December. That will take the cash rate above 3%. That will be restrictive, and we'll see that later. That there is some risks there to the economy. But what this is really saying is the RBA went from in April saying there is no need for us to hike rates until 2024 to hiking about a week and a half later, then to hiking several times to get the cash rate 2.75% higher than it was at the start of the year. In the US, a similar story. The latest inflation print is 7.7%, higher than it was at the start of the year, albeit off peaks that were very, very high, around 9%. And the Fed has hiked even faster than the RBA. They've hiked now from 0.25% to 4%, including 4 consecutive hikes of 0.75%. And they're talking about doing more, and they will do more. And it's really that is making it so challenging, and has made it so challenging for markets to determine what's going to happen next year, what the economic outlook will be like, how inflation is going to react, and how the Fed and the RBA are going to react in response to that. And ultimately, what we're seeing in the markets is volatility that reflects that uncertainty and reflects the challenges that the central banks are facing. Now, there we are. The big question that is driving that uncertainty across the US and across Australia is about, will the Fed have a policy error and drive a recession down the throat of the economy? I was remembering that we've had a recession fairly recently in 2020, a pandemic-driven recession. Since then, the economy rebounded very quickly. And as we entered into 2022, there was a lot of economic momentum coming through in the US. Since then, we've had a host of other uncertainties, the Ukraine war, we've had the ongoing Chinese lockdowns, midterm elections in the US. But fundamentally, the market out there, the consensus out there is saying to themselves, is the Fed going to cause a recession early next year that will justify a really deep drawdown in equities and a sell-off in bonds? And I can tell you that the consensus right now is that inflation is going to take a very long time to normalize, and that there is a risk of a wage price spiral in the US, and that the Fed will probably have to do even more rate hikes to rein that in. The consensus is that the Fed's going to have to get the Fed funds rate to at least 5%. And that's after a 0.25% at the start of this year. In fact, a 0.25% right through to May. We're talking about a 4.75% rate hike pathways in a very short pace of time, over 12 months, to rein in inflation. And the consensus is saying that will be recessionary. The US economy will likely enter recession early in 2023, and that's going to be a very painful outcome for markets, and hence that sea of red that we saw at the start of this year. That forward-looking market is telling us that there's a recession coming. We're not sure that there has to be a recession, and there's a few reasons for that. If we look at point one here, inflation will take a very long time to come down. Well, if we look at what's happening in the market, and you can see on my chart here, inflation expectations, in fact, are very well behaved at the moment. Now, this takes a little bit of explaining. The orange line is a measure of forward-looking inflation over the next 5 years. The grey line is another measure of inflation on average over the next 10 years. And there's a little brownish grey bar there that shows what the Fed's target is for CPI inflation. Now, earlier this year, inflation expectations were very high. The Fed was right to be worried, but they've hiked a lot, and now inflation expectations are below the Fed's target. That is, the market is expecting inflation to be below average, or below the target on average over the next 5 years. The market is pricing this grey pathway for rates over the next about 18 months. You can see that from 3.75 now, we're expected to get close to 5% and then cut straight away. The market is saying the Fed will have to cut because they're going to cause a recession. The Fed has not done this in the last 20 or 30 years. In fact, the typical pathway for the Fed in hiking rates is to get to a level that they're comfortable with and then sit there for 6 months, 12 months, up to 24 months, and see how that monetary policy is impacting the economy. So again, the consensus has a view that is very much at odds with history and very much at odds with the facts. And so from our perspective, while we think there is a risk of recession next year, probably later in the year, we don't think it's inevitable. We think it can be avoided. And we think over the last week or two, the US Fed has been trying to get hold of a narrative that says, hey, you know what, we've done a lot of rate hikes. It's time for us to start pausing. And we think we could see a pause as soon as February or March next year. So that's the US. What about Australia? And we're all here living in Australia, and it's a question that markets have been grappling with now, because we're seeing the RBA hike in a way that they haven't hiked for in a decade or so. The cash rate has gone from 0.1 to 2.85. It's likely to go higher. It's going to get above 3%. It's going to be at levels that we haven't seen in many, many years. And rightly, there is some angst and concern out there that the RBA could overdo it and in their own way drive a recession onto an economy that really doesn't necessarily need it. So some similar points here. Interest rates, in our view, are not really restrictive yet. They're higher than they have been in many years, but we think interest rates begin to really bite the economy above 3%, and we're likely to get there in December. They probably will go higher, but not by much. And what I thought I'd show on this chart is the actual RBA cash rate in grey, and then some dotted lines that shows where the market thinks the RBA is going to get to. And then in orange, the standard variable mortgage rate, and again, dotted lines where the market thinks it's going to get to. And the market is saying, oh, we think the standard variable mortgage rate is going to get close to 9%. That's as tight as it has been since before the GFC, and the impact on households would be as painful as it was in the 80s when interest rates were much, much higher. The RBA knows this. That's why they've started to slow their pace of rate hikes. They don't intend to crush the economy, just slow it down. And they've seen already that the impact is slowing the economy, and it's slowing the economy through the housing market. And the RBA spends a lot of time thinking about the housing market. We've seen already the housing sector has slowed. And in this line chart here, I've got house prices in orange, annualized. They're down over the last few months, but what this is not really showing is there's been a 20% almost decline in peak to trough. And that's been very, very rapid in house prices. There's also housing activity is slowing. The auction clearance rate is slowed, and we see almost daily, it seems, at least weekly in the various newspapers who fixate on this, that there are challenges out there in the housing market, and it's being driven by the RBA's monetary policy, and it's being driven by the pass through to higher rates. And so the RBA is not job done, but they're getting close to job done. Furthermore, Australia continues to be very linked to China. China has been in recession all year, in our view. Growth has slowed well below where its target would be. They are struggling due to a housing sector slowdown and ongoing lockdowns due to their zero COVID policy. That's that growth struggle is likely to persist in the near term, at least. But we think and we observe that China is slowly reopening. There is increased mobility. There is increased mobility between mainland China and Hong Kong. Foreign dignitaries have visited China recently, which hasn't happened in 3 years. President Xi has left China, which hasn't happened in 3 years, and they are moving towards a softer version of zero COVID that we think will support economic growth and that will support Australia. We also saw Prime Minister Albanese meet up with President Xi in China the first time in 6 months. That's a broad positive, we think, for Australia's economic outlook. So again, from our perspective, we think recession is not inevitable in 2023. We don't need to have a recession to slow inflation. The monetary policy will allow that to happen, but there will be more. There will be more hikes, at least in December, most likely in February, probably in March. And by then in Q2, the RBA could be done. and they could leave rates at that level for 6 months or 12 months and extend the economic cycle. And the upside risk to this is not only that we avoid recession, but actually that we get a tailwind boost from China's reopening, which is certainly not part of the consensus view at the moment. So that's a slightly different take to the consensus that we saw in that first chart, is pricing in something akin to a Great Depression, expectations for recession at the very least. But having a different view doesn't mean that we do nothing. We need to look at what happens in market pricing. We need to think about how that impacts portfolios, and we take action through the course of the year to try and prevent the worst of the impact of that sea of red that we saw in the first slide on portfolios. So what have we been thinking about this year? What have we been doing? Well, two parts, fixed interest and equities. And I've got a chart here that shows the move higher in 10-year government bonds in Australia and the US. You can see they've gone from under 1% to above 4%, which is a painful move. Over the course of this year in 2022, we went from having virtually no exposure to government bonds and thinking that they were very unattractive, to more recently acknowledging that at 4% plus, there is some reasonable income and reasonable returns on offer from government bonds. That's something that hasn't happened in probably 5 or 6, maybe 10 years, depending on the market. But more importantly, given that markets are pricing recession, given that they're looking at a depression-like pricing, we think that government bonds, the higher yields, provide a lot of downside protection for portfolios. And that's really important because it is difficult to find downside protection, but with yields at this level, there is some. Within the equity space, we've been progressively from the start of this year becoming somewhat more defensive in our exposure. That means increasing to infrastructure, thinking about quality, thinking about value as types of equities that can protect on the downside through that volatility and protect against that sea of red. That said, we didn't throw the baby out with the bathwater and get rid of all of the growth exposure. And we know, and I'm sure Chris may mention this, but we know that that growth has really struggled this year. Tech has really struggled this year, and that's happened as that government bond yield has surged, and we've seen valuations really get hit. We've been continually reducing our exposure there, but not removing it entirely, because if the consensus is wrong, if there's not a recession, if the central banks get this right, then you will want that diversification and exposure within the portfolios to provide some upside. So I'm just going to conclude very quickly and pass over to you, Philip. The consensus outlook is quite negative on the global economic front. Markets have moved to price that in. More recently, there's been a slightly better outlook on that from a bit of a market rally. We think that there are plenty of risks out there, but we don't think a recession is inevitable this year. We've been moving and thinking about portfolio changes to protect on the downside, but there are opportunities coming from that, and we like to work with our managers to try and take advantage of those. With that, I'll pass over to you, perhaps, Philip, and you can, Chris.
Great, thanks, Isaac. I just had one quick question while we change over the presentation, so I'll get you to take that one down, Isaac, and we'll switch over the presentation. But basically, I just wondered if you could explain to the audience, in your mind, why bond prices or sort of fixed income returns are so negative when interest rates are going up. I think that often confuses investors about why they're seeing such negative returns when rates are on the rise.
Yeah, it's a great question. So bond returns tend to be driven by the interest rate on offer. That is the yield, if you like, that you're going to receive. But they also get driven by the capital gains when bond prices move. As the yields move up, the price of that underlying bond moves down. Now, if yields move up gradually and slowly, the income on offer will offset the decline in prices. when they snap higher like they have this year, we're talking 2%, almost 3% higher in a very short period of time. That higher yield cannot offset the loss that you get from the price of the bond, and so we have this this very painful reset as that takes place.
Great, thanks, Isaac. And I think some of the response to that in the portfolios was moving into shorter duration type bonds, wasn't it, this year, or even mostly this year, I guess.
That's right. We tended to have bonds that had less capital losses as a result of yields moving higher.
Yeah, perfect. Great. Thanks, Isaac. And over to you, Chris, to run us through, I guess, what's happening and your thinking down there at Pendle around stock selection and markets.
Thank you very much, Philip, and also to Isaac for such an excellent macro roundup. I just wanted to check, can everyone see my presentation? Does that come through? Excellent, wonderful. So as mentioned, my job this afternoon is to talk you through how we're positioning the portfolio. So I'm going to spend a little bit of time talking about the context and the structure that we use to build the portfolio in the current environment, which is one of obviously quite high uncertainty. So we have to be very mindful to build a portfolio that's not going to perform just in one sort of pathway and outcome, but one that gives us a lot of optionality in various different pathways, depending on how the economic and geopolitical situation unfolds. So I'll talk a little bit about that framework and structure, and then I'll just delve into some of the positions that we hold within the portfolio and talk you through the rationale behind them. So firstly, yes, here we go. So the way that we're thinking about the market at the moment, it's obviously a very difficult market to invest in because there is such uncertainty out there. And Isaac hit the nail on the head, and sort of the key issue out there at the moment is obviously inflation and central bank responses to it. And the way that we observe the market at the moment, and it has been a market of a lot of volatility. We've had, periods of quite dire investment sentiment where markets have come off a lot, followed by periods of more positive a more positive outlook, and we're sort of going through one of those at the moment. And really, we can think about that as sort of market sentiment bouncing between two sort of extremes in terms of how the current economic picture may unfold. And on the left, we've got the more benign stream, which is probably the one which holds sway at the moment, I would say, which is that inflation continues to ease. We obviously had a softer than expected inflation data print from the US, which has helped prompt this shift in sentiment recently. If that continues, we're mindful that is just one data print, but if that trend continues, that will allow the Fed to ease off in the manner that Isaac has described. The impact then of the tightening that we've seen on the economy will be more moderate. That will feed through to a more moderate outlook or a more moderate impact on corporate earnings. And as a result of that, that's a scenario which is consistent with sort of a 10 to 20% drawdown in markets. And I'm going to be very careful when I'm talking about this. I'm here referring to the US market, and we've kind of seen that already. So this is sort of a total drawdown from where we began. And as we saw from Isaac's slide, the US market is down about 20% year to date. So if that's the scenario that unfolds, we think maybe we've already seen the bottom in markets. We'll probably bounce around for a while yet until we get a bit more clarity and visibility on the pathway of inflation. But in that case, you can foresee a scenario where we start to get a recovery in equity markets towards the end of this year and into the start of next. The opposite pole is the more bearish scenario there on the right, and this is one where inflation remains stubbornly high, where the impact of disrupted supply and high energy prices continues to push through inflation. That starts to feed through to that wage price spiral, and in that case, the Fed has to, and central banks around the world have to continue being very tight in terms of monetary policy, continuing to hike rates until the point where we see the US economy tip into a recession. And if that is the case, then you would see a larger impact in terms of corporate earnings, and that in turn could drive another leg down in markets. So if that more bearish case unfolds, perhaps we've got a little bit further to go in terms of this sort of market downturn. Now, one thing I will say is that some of that tail risk in that more bearish scenario has definitely receded in the last couple of weeks. And, a couple of factors at play there. Firstly, that US CPI print, which came in softer than everyone expected, was a key one. But then there was also what's happening in China. As Isaac mentioned, that shift in terms of the approach and some sort of clear signaling from Beijing around winding back COVID zero. And the other one I'll point to is some regulatory changes in the Chinese banking system, which have effectively eased the pressure that banks were feeling to limit their lending to the Chinese property market. And that's very important because the Chinese property market is a huge driver of that economy, also a huge driver of resource demand for Australia. So there's a clear signal there that Beijing is easing up on some of the regulatory pressure on the property sector as well. So those two things, what's happened in China and what's happening in US inflation, we think some of that tail risk from that more bearish scenario has definitely receded. But we're still yet to see ultimately what the impact on the economy from monetary tightening and the impact on earnings will be. And hence, at this point, we think it's too early to call one way or the other. And the outcome, to be clear, will probably lie somewhere between these poles, but it's too early to talk about sort of which skew it's going to be. And for that reason, we need to build a portfolio which is balanced and has a diverse range of exposures that can do well in either scenario. One thing we are quite mindful of, just with regard to what's been happening, is total financial conditions. And we know this is a measure that the Fed is watching. And this basically captures not just interest rates, but things like corporate credit spreads, things like the impact of currency, and also equity markets. And what this index does is sort of reflect the entire impact of all those factors, which do have in concert a tightening or loosening effect on the economy. And what we can see is that overall financial conditions have tightened from where we were, which has been the loosest point going back well over 20 years. But we're sort of back into kind of the mid-range we've got to where we have got in previous cycles, the last couple of cycles in terms of tightening. The question is, how much further do we need to go? And it is one thing we just bear in mind, particularly with regard to strength in the equity market index, in that we've seen a rebound recently. If that persists for too long or becomes too strong, it will start to act contrary to what the Fed is trying to achieve in terms of bringing inflation to heel. So we are very mindful of that. If equities do run too hard, too fast, you may see some comments from the Fed to try to rein them in a bit. And again, that's just another reason which gives us a little bit of caution at the moment with getting too carried away with the current market rebound. As I said, we think it's probably a little bit too early to come to conclusions there on where we land in terms of earnings. And before I go into the portfolio, the last point I wanted to make was around the Australian market. And again, we saw this in Isaac's slide at the start, that while the US market is down that kind of just under 20% for the calendar year to date, the Australian market's only down sort of low single digits. It has held up much better than global equities in this environment. We continue to see it as a much more defensive equity market in this environment. And there's a number of different reasons for that. You can see that listed here. But probably the foremost one is that the inflationary issue that we're facing here in Australia is not as acute as it is in the US, and hence the imperative to tighten here is not as great as in the US. But there are a couple of other factors there as well which have led to a better outcome for the Australian market. So when it comes to building a portfolio for this environment, we want different kinds of stocks. Because as I said, we don't know the pathway that we're going to follow from here. So we need to build a portfolio that's got different kinds. If we do get that sort of more bearish outcome where inflation remains high and we need to see some tighter monetary policy, we've got those domestic defensives. If we do start to see the economy tip into recession, we've got those more resilient companies. We think it's important, notwithstanding the fact that it is a part of the market which has struggled as bond yields have gone up. We think it's important to have those growth exposures. The nuance here is that it's really important to be very selective in the ones that you hold. You want companies with very sort of strong fundamental growth stories and ones that aren't just relying on sort of the tailwind of falling bond yields to outperform. So we've got a few of those in the portfolio for the reason that Isaac mentioned. If we do get an environment where monetary policy starts to loosen faster than people are expecting, you would expect those growth companies to perform well. In this environment, we think, as well as the domestic defensives, it's important to have stocks which are returning capital to shareholders because in this environment, if you've got companies which are buying back their own stock, it is an additional pillar which can help support that stock price. It obviously demonstrates capital discipline quite often as well, and the free cash flow obviously to underpin that. So we've got a number of sort of good, strong capital returners in the portfolio. If inflation does persist, we want companies with pricing power who are able to offset that or even benefit from that. So we've got our pricing power plays. And then we've got our quality cyclicals. And these are companies which will see and have been seeing a negative effect from the slowdown in the economy. However, we think these are companies which are in very strong competitive positions, ultimately will be winners within their industry. They're companies that you do want to hold on a 3 to 5 year basis, notwithstanding the fact that you might feel a little bit of pain with them in the near term. But ultimately, if we do get the more benign end of that outcome, if the impact on the economy and on earnings from tighter monetary policy isn't as harsh as people currently fear, it'll be these kind of companies that do well. So putting it within that kind of framework, I'll now sort of show you a few of the positions that we have in the portfolio. I want to stress this is not investment advice. Obviously, go and see Phillip and his colleagues to talk through any sort of these the companies. But this is just to give you an idea of some of the companies that we're holding in the portfolio. These aren't all the companies, but these are some of the key positions within that context that I've just laid out for you. A key thing that we're trying to do within each of these kind of buckets is pick companies where we like them for that thematic exposure that they're providing, but they've also got a very strong stock specific story, so that even if the thematic environment isn't conducive for them, that they've got enough going on at a company level which can continue to support the stock. And a good example of this is amongst those domestic defensives there on the left. If we think back to 2001, which was a good market for equities, sentiment was pretty buoyant, and generally defensives underperformed in that environment. However, Telstra and Metcash, which are two of the defensive companies that we held, had enough going on at a company specific level that they were still actually able to outperform. So, Woolies and Coles both underperformed during 2021, Metcash outperformed, and likewise the rest of the telcos also underperformed and Telstra outperformed. And I can go into a little bit more detail if you'd like about what was going on there, but that just sort of demonstrates the principle that we're trying to achieve here. So they're two of the domestic defensives that I've just talked through there. The growth stocks, as I said, these are parts of this part of the market has had a pretty torrid time over the year to date as bond yields have gone up. That normally feeds through to underperformance from the growth stocks. Some of these companies now, particularly names like Xero, are outstanding value, we think, on a 3 to 5 year view. So we're very happy owning it here. And the important thing here is that the fundamental growth story is quite attractive. It's not just about being reliant on the macro environment shifting in its favor. Capital returners, so stocks with, as I said, good, strong free cash flow, where management are being disciplined and returning it to shareholders, Santos 9 and South 32. The inflation beneficiaries, or at least the companies with pricing power. If you've traveled anywhere recently, you've probably felt Qantas's pricing power at the moment. But it's obviously a tough environment in terms of fuel costs. But the manner in which Qantas has emerged from COVID in a stronger competitive positioning with a lower cost base has meant they've been able to offset that higher impost from fuel. And sort of maintain revenue and return to profitability far faster than people expected. Some of the commodities names as well, their mineral resources, moving increasingly into the lithium space. And then we've got our quality cyclicals. So these are companies, and we've seen this in the most recent updates from them, which are feeling the pain of a downturn in an economic cycle. We're confident in the ability of these companies to weather that period. They are all in strong competitive positions. You know, they will ultimately be winners in their industry. But as I said, if sentiment changes very quickly with regard to a milder outcome in terms of the economic and earnings effect, these will be the companies that expect to outperform then. And, you know, if you're scrambling to try to catch up to them at that point, it's too late. So hence we're sort of happy to hold them as part of a diversified portfolio. I'm just going to spend the last 5 minutes just delving a little bit into a couple of those names before we then sort of return for a Q&A. So Metcash, there's a lot going on in this slide. The key points that I wanted to draw your attention to here is that inflation there in the top right. So for many years, the supermarket game has been a tough one in Australia. You basically had a very competitive battle between all the supermarkets, primarily Woolies and Coles, but Metcash and through its IGAs also involved in that, where it was just all about trying to gain market share through price deflation, you know, through discounting. That has changed now, and we're seeing inflation turn to groceries, and as a wholesaler, that benefits Metcash. You can see that there on the right, and on the top left there. They're starting to grow their network of stores again after reducing them for many years. So again, that is positive. They're being very targeted about where they're opening up their new supermarkets. And you can see down there on the bottom right, and this is very interesting. You know, during COVID, when people were more inclined to shop locally, that was a strong tailwind for IGA, who tend to be sort of more neighborhood based rather than in CBDs or sort of larger regional centers. And the remarkable thing about Metcash is that they've been able to hold on to those market share gains that they made during that COVID period. And a lot of this was a result of the investment that they'd done in previous years, you know, consolidating and improving the range of goods that they were offering, just the look and the feel of the stores. A lot of people were returning to IGA for the first time in a while and actually quite liked what they saw and had a good experience. And as a result, you're starting to see, we're continuing to see IGAs holding on to their market share gains that they've made. So that's all quite positive. And the other thing to point out is the strategic change in Metcash as well. And you can see this down here in the bottom left, that actually the contribution to earnings from IGA, having been almost 90% if we went back to FY13, is less than half now. And this is as a result of primarily the investment that they've made in the hardware business through Mitre 10s and Total Tools. And so as a result, you've got a more diversified business. And whilst the supermarket business is sort of steady but very low growth, you've got more of a growth opportunity there in hardware. So that's Metcash, one of the domestic defensives that we hold. CSL's a really interesting one because it's a growth stock which didn't really participate in the surge in growth stocks that we saw during the COVID period. And the very simple reason for this was that it couldn't get the plasma that it needed to create its products. And that was because of the lockdowns in the US. People couldn't get to the collection centers. So CSL was a company that was continuing to see huge amounts of demand, but just couldn't supply it. And what this shows you is donors per week. And you can see there following that black line, which was the amount of donors in 2020, how that plunged over sort of March, April and May. As the lockdowns took place, it started to recover in 2020. And then in March of 2021, which if you go back to the left, and you can see there in that grey line, you had extra fiscal stimulus coming through from in the US. And again, people, as a result of this, didn't need to be going out and producing plasma at the collection centres. And so again, you saw a dip down there. What we've seen in 2020, which is that red line there, is that plasma collection has now recovered to levels above where it was pre-COVID. So that supply issue is receding. At the same time, there's been a lot of investment in new collection centres, new collection systems, which are much more efficient. And we're also expecting to see sort of a rollout of new products for CSL. So there's a number of things aligning for CSL, which make it look very attractive as part of that growth cohort. Xero is an interesting one, growth stock which has struggled. This is the valuation of Xero there in the dark blue versus some of the other tech stocks in Australia, and particularly you can see it's underperformed there, particularly against WiseTech there in red. And we think this is a pretty compelling valuation for Xero at the moment. This is a very technical slide. I'm not going to go through it in huge detail, but basically what it tells us is that at the moment, the market is valuing Xero with sort of no scope for growing, either subscriptions or revenues or margins. And we actually think all three of those things will increase in coming years, particularly driven by regulatory changes in the UK, the Making Tax Digital program, which is forcing small businesses in the UK to go online in terms of taxation. And this is going to be a huge sort of transformative opportunity for Xero, we believe. So a lot going on there at Xero, which isn't factored into the share price at this point. Nine, I flagged as one of those cash generative and sort of capital returners. And again, people think about Nine, they think about free-to-air television. And, again, that's historically been a very tough business. But it's important to point out that, again, Nine has had a structural transformation as well. This was something that was going on sort of from 4 or 5 years ago and has then been accelerated by the acquisition of Fairfax a couple of years ago. But you can see there, if we look on the left, the revenue mix from FY18 to FY22, firstly, the huge increase in the scale of revenue that this business has generated over those 4 years, but also the proportions where free-to-air television or more traditional media there in blue has gone from about 3/4 of revenue to where we are today, where it's less than half. And you've got things like Domain, things like Stan and other digital offerings. What this means is the company has more levers to pull to deal with the economic cycle. It's a more diversified business and a better business. I'm going to leave it there just in the interest of time and hand you back to Phillip.
Great, thanks so much, Chris. I think what I'm picking up from some of the stuff you're saying there is just the work that's going on at a portfolio level down there. You can kind of see that obviously the detail, the research, and the slides looked very complex. I'm sure it was obviously difficult for everybody to understand what was going on, but we can obviously see the work that you guys are putting in. And obviously has resulted in your previous performance success in the portfolio. So yeah, I think that went really well. In terms of questions, anyone from the participants, please feel free to add your questions to the Q&A section of the webinar. And I just guess I just had a question about, so with Nine and just sort of that acquisition of Fairfax. Did you want to kind of maybe talk through that and how that kind of occurred a couple of years ago?
Yeah, it was. There was a couple of interesting aspects to that. They were both companies which had a stake in Domain, and so as a result of that, sort of had a relationship, I guess, in that sense. But just very complementary businesses in terms of Fairfax, obviously, print media. Was a key part of that business. And again, a part of the business that the market wasn't ascribing much value to. But when you marry that up with sort of the television and some of the digital media that Nine had, there was actually quite a bit of synergies there where you could, repurpose content across those various different platforms. The other thing that's actually quite interesting is that print media has been in structural decline for many years now. People obviously moving to consume news online, various different formats, but that seems to have plateaued. And what we've seen from the last sort of few halves is that actually that's stabilized now. The sort of subscriptions for print media. And likewise, sort of the revenue that they're generating from it in terms of advertising. And that can only help if they can demonstrate to potential advertisers that those trends have stabilized. Then, potentially they can earn more revenue from that part of the business. So Nine is a company at the moment that it's in one of those nice spots where sort of every part of the business, notwithstanding there's pressure in the housing market, which has made itself felt in Domain's stock price. But actually most parts of the business are actually humming along quite nicely.
Yeah, it looks like they've certainly got ahead of that trend, rather than just sort of sitting back with their sort of, I guess, free-to-air TV, and they've obviously got ahead of it and diversified their income streams, which is always great to see for a business like that. Definitely take your comments about picking up businesses at reasonable prices, sort of valuations in some parts of the market. I think, what I've sort of seen and heard is that there are some great buying opportunities depending on how things land. But if you, like you mentioned, I think you talked about a 3 and a 5 year type of outlook, or what you were sort of looking at. And I think that's what's really important, is that we have to always assess investments over a much longer term. And that's where we can sort of set ourselves up to get good positions that will pay later on down the track. So I think that's kind of makes sense. And I've certainly seen I've been advising for about 15 years in the investment space, where, a company at a certain price, it can move very, very quickly. So, like you say, sort of holding at current prices and sort of having a longer term approach makes sense.
Yes, I mean, these kind of periods are very tough for investors. They feel challenging when you're in them, but they're also an opportunity in many regards, and you don't get many of them. They sort of come across every maybe 5 or 6 years, where you get this opportunity to pick up great companies at really good prices, and they often set up your next leg of performance. If you can keep your head and just maintain that focus on the fundamental value of the company and the strategy that management are following, they can be great buying opportunities.
Yeah, fantastic. Well, thank you so much to both of you for basically coming along today and sharing your insights with our clients. We know that it's highly valuable to them to get better understanding of kind of, I guess, what's going on behind the scenes and how things are shaping up, how we're responding to what's happening in economies, and obviously the stock level as well. So thank you so much for giving that additional insights. We know that there's been conversations this year with clients have been obviously very, very interesting, and obviously helping them to understand what's happening, because it is uncertain, and you've only got to watch the news. Of course, they always, when the market goes down, it's a big deal, of course, and can create a fair amount of, I guess, angst for people. I guess talking through, again, that longer term, often I talk about the fact that, people are holding quality companies, quality bond portfolios, and I guess over the longer term, and when we take sort of averages over a period of time, sort of setting, just working that through. But of course, over the short term, we understand the challenges for clients in seeing that longer term picture. So I guess that's kind of it for today. And thanks again for coming along. We obviously are hopeful that things will work out. I think, Chris, you had a slide on the left-hand side, the more positive sort of outlook. We're hopeful of that, but of course aware that there are risks that the other type of scenario could play out. And Isaac, you highlighted how things could be. You're sort of saying, look, recession, we don't think is inevitable, whereas where some parts of the market have actually priced in a recession with a fair degree of certainty. So for us, it's a bit of a wait and see. But of course, we're watching portfolios, and we're working with quality people like the guys here today. And there's many others actually that form part of our portfolio process to help navigate markets and keep on the front foot of where things are heading. So yeah, thanks again, and have a great afternoon, everybody.
Thanks, Philip.
Thank you so much.
Thank you very much. Bye-bye.
Cheers.
Bye.